Are we doing today? Good weekend? Looking forward to next weekend when it's 3 days off instead of just 2 days off. Yeah. I had a good weekend. I had my cheeseburger yesterday, so I'm in a good mood. That being said, I did want to talk really quickly about the first day complete stuff that I mentioned. So I mentioned this to AIS, and they're based on the responses I got from the people who were looking like there was a lot of head shaking. I tried my best, based on the instructions, to try to make Connect accessible, because apparently what you're supposed to be able to do is create this link, and then you click on this link, and it's supposed to provide you with access to the textbook and the link. But you're going to see what happens when I click on this link. It basically says, hey, there's no materials associated with this course, which is not true. There are very definitely materials associated with this course. So then I said, all right, well, I know there's a there's a Connect tool that I could actually set up. So I tried to actually access the Connect tool and create an assignment in Connect that I could link into. It was just a reading assignment. So I created that and click on that. And the idea is supposed to be that it opens up into Connect, and then you can actually access the ebook by clicking on this right here. That's the idea. And I was hoping that it worked. I did not see a lot of successful like celebrant faces in AIS. So my guess is it probably doesn't work. Just as an update to that for that, I have contacted, so first of all, I contacted the bookstore manager. She has not responded to me, which is a little bit disappointing. But I also contacted Barnes and Noble customer support with a detailed description of what was going on. So hopefully we'll get that resolved. And so if you're still waiting on access to the course materials and you can't complete the next assignment without them, please let me know. Just because I don't want anybody falling behind in this regard, or just for this. Again, I'm a real big I get really annoyed when people pass the buck, and that's kind of felt what it feels like it's been done here, is that somebody said the first day complete materials. Now it's on the instructors and the students and it's their responsibility, it's their problem. And it shouldn't be anybody's problem, but I'm going to try to take the burden for that and not leave it on you guys. So let me know if there's a problem. We'll work something out. Hopefully this will get resolved sooner rather than later. Yes.
You got I suppose, will there be any assignments in Connect?
No, so there's nothing in Connect. The only reason that you need Connect is that that's how you get ebook access. And so that is the only reason for Connect. And in the past, it's not been a problem, because if people got Connect for ebook access, then great. If they didn't, there's no assignments there. But well, I'm sorry. But in this situation, given that I said digital copies, I think at first day complete, there are a lot of people who got digital copies, which is fine. It just creates a little bit of turmoil and confusion. So the answer is, if you got a printed textbook, you're actually in the clear. This is only for those people who got digital stuff for first day complete, which it's a small amount, but it's not a zero amount of people who did that. So I sincerely apologize for those that fell in that category. If I know that this was going to be an issue, then I would have kind of reached out beginning of semester, but obviously we get wiser by making mistakes. And so that being said, this is a small issue. We can get this resolved. We can fix this problem. It's not going to be something that's going to change our course. We change space. We can fix this. Part of that is going forward with the material and making sure we have all access to all the materials we need. So today we've got two things we're going to be talking about. We're going to be talking about materiality, wrap up chapter 3, and then we're going to be talking about client acceptance, which was a discussion assignment I asked you all to do. I think I had a few people who reached out to me, and I just want to reiterate, for the discussions, there are no deliverables. There's no points associated with them. I just want you to make notes so that when we get to that point in class, we can discuss it and we can make a judgment to that. There will be, quote unquote, an assignment for chapter 5, like you've been explicitly assigned to do something for chapter 5. Again, there's nothing that you have to submit. You just have to be prepared to talk on chapter 5. It's the one time in the semester that I'm going to go Socratic method on everybody, and I'm going to call out, but I'm at least it's not cold calling. I'm actually going to be telling you what you need to be prepared to answer. But that's on Brightspace, in case you're curious about that. So alluding back to what we talked about on Friday, and from our first lecture on Wednesday, what did I say about the concept of reasonable assurance? Okay, I remember I said reasonable assurance, and I said something about absolute assurance, associated with that absolute assurance. Why do we use reasonable assurance instead of absolute assurance? Absolute assurance is obviously much stronger. So we instead, auditors say we provide reasonable assurance. Right. There's no way to get an absolute guarantee on something. It's just impossible. It's literally impossible. And I'm not misusing the word literally there. So The idea behind reasonable assurance is that this is the highest level that we can feasibly provide. We can reasonably provide. So an auditor designs an auditor to provide reasonable assurance of detecting misstatements that are sufficient magnitude affect the judgment of reasonable financial statement users. Basically, what that means is there is a threshold. We can be off, but if it's like a certain amount, we don't care. It's a little bit like, does anybody balance their checkbook on a pretty regular basis? So some people have the kind of the philosophy of balancing their checkbook that they're just kind of like has to be to the penny. My dad was like that. If it was to the penny, if he was off by a penny, he would scour and try to figure out what the difference was, like what the mistake he was in making math. Me, if I'm within $5, I'm good. Okay. I'm just kind of like, I don't care. I don't care. Been doing audit too long. Okay. So there's certain threshold that people have, and they were going to say that is material amount versus non-material amount. We discussed this concept. Okay. And so materiality is assessed to determine the potential effect of a misstatement on decisions made by a reasonable user of the financial statements. It's not were the financial statements correct, but were they materially correct? We expected there to be $100,000 in cash. There's $999,995 in cash instead of $100,000. Are you going to freak out about that $5 or not? Okay, are you going to weird out? And that is kind of the answer that we're going to be discussing here, is trying to determine out what is a material amount for an audit. Now, like I said, materiality is going to vary from individual to individual. And I used to have this little activity that I did with class, and I said, all right, how much would you be upset about? Like you assume that you've got a certain amount of money in your wallet, and you're off by, and then I said $1, and how many people would be upset about that? And then I started like $2, $3, $4. Okay. The problem is that everybody in the class was like off by $1, but he was raising their hand, and it's just kind of like, yeah, okay. That really defeats the purpose if everybody's that critical. And then again, $1 may be a material amount when you're a college student. Okay, that's the difference between I guess buying a soda and not buying a soda. I don't know. What is it you crazy kids buy nowadays? It's like we drink water. Dr. Barnes can't afford the sodas anymore. Yeah. All right. So one thing that we want to note is that this concept of materiality pervades pretty much everything we do as auditors. We're going to use this term a lot. We're going to see the word material a lot. In fact, the financial statements, or sorry, the audit report are going to say this following phrase about the financial statements. It's going to say the financial statements present fairly in all material respects the financial position of the company. Is that saying it's 100% accurate? No, it's saying it is close enough that it is materially accurate. And that's the concept we're holding to. Now, this sounds very straightforward, and it's not difficult at face level, but the calculation and the consideration of this can get really, really dicey. It can get really, really nasty. And that's going to be something that's going to be relevant to your homework, which we're going to talk a little bit about. So let's go ahead and talk about the philosophy. Let's talk about the concepts, and then we'll talk about the application. So an important part of audit planning is to determine materiality for the financial statements as a whole. Okay, that is called planning materiality, and to decide on tolerable misstatement for significant accounts or disclosures. Now, I want to make a note of this because I will always refer to these by those two terms. If I'm talking about financial statements as a whole, then I'm going to be saying planning materiality. I'm going to use those two words, planning materiality. If I'm talking about financial statement, or if I'm talking about materiality at the account or disclosure level, and you can just think of it as the account level. We don't need to get too detailed about disclosures, because we're not going to be testing disclosures specifically. So we're going to think about materiality at the account level. I'm always going to refer to that as tolerable misstatement. Occasionally, you may come across different terminology. This especially holds true if you're planning on sitting for the CPA exam, where they use different terminology. Oftentimes, they call this concept right here, tolerable misstatement, they call that performance materiality. And it gets a little bit confusing. One of the things I can advise is that whenever you're answering a question about materiality or dealing with a problem involving materiality, be very certain about what concept you're dealing with. Are you dealing with materiality at the financial statement level, or are you dealing with materiality at an account level? Because those are two different concepts. Regardless of the terminology used, they represent different conceptual constructs. So what are we going to do? We're going to determine overall materiality, then we're going to determine our tolerable misstatement. And then based on our testing, we're going to evaluate audit findings. Now, this generally occurs after all the testing is complete, so we're going to shortcut a little bit, but we need to talk about how we use this part in planning to frame the rest of our test work. That's going to be our goal. That's going to be our goal. So here's the deal. Planning materiality is the maximum amount by which the auditor believes the financial statements could be misstated and still not affect the decisions of users. So, like I said, some reasonable user amount, there's a threshold where we say, is this a material amount? And up until that dollar point, they say no, no, no. And then you hit that dollar point, and they say, yes, that is a material amount. Obviously, it's not that clear cut. It's like you say, okay, $10,000 is a material amount, and you go up to somebody and says, we're off by 9,999. They're not going to just necessarily be like, oh, okay, well, as long as you're below 10,000, okay. It is a subjective assessment, but theoretically speaking, there is some dollar amount that we assume there's a threshold for materiality. As long as we're under that, we're fine. If we're above that, there's a problem. Now, here's the problem. Auditing standards require the auditor establish a materiality amount for the financial statements as a whole. This is required under both ASB and PCAOB auditing standards. They say you must establish materiality. So then we come back and say, all right, how do we do that? And they say, I don't know. They don't actually say those words, but it might as well be, I don't know. None of the standards don't actually provide specific guidance on how to determine planning materiality. So this is a subjective exercise that is usually up to the accountant to make that determination. So we're going to talk about some general guidelines. We're going to talk about a rule of thumb, which is just basically a standard that we're going to use for our application. And then we're going to talk about when we had to diverge from that. So first of all, we need to talk about quantitative and qualitative benchmarks, or qualitative benchmarks and factors. So quantitative benchmarks are basically saying, here's a number that we're going to use as our basis. The most common one is going to be income before income taxes, okay, or pre-tax income. It says loss, okay, but if your company, if the client that you're auditing had a loss in the current period, that's probably not a good threshold for evaluating materiality. It's like a negative number, all right? It's like, yeah, we want everything to be negative, and if it's above zero, then basically that's a material amount. That's obviously silly, okay? It's obviously silly. So pre-tax income, assuming it's a positive amount, is our general guideline. We're going to talk about some caveats to that here in just a second, but there's some other bases we might use: so assets, revenues, net assets, and total equity. Okay, so that's the basis. This is our quantitative basis, but there also might be qualitative factors that make us adjust this amount. So let's say I'm going to use 5% of pre-tax income as my base. And by the way, that will be kind of our guideline, our rule of thumb, but we'll get to that in just a second. But let's assume that I'm starting with 5%. And then I say, are there any reasons that I might want to adjust to a number other than 5%, like make it higher or lower? I could consider qualitative factors. Now, first of all, as a quick note, quick aside, most qualitative factors will adjust downward. It is very uncommon that we adjust upward. So if we have a benchmark, we generally say, this is our basis. We will adjust downward if necessary. We very rarely. It makes sense because we can actually see a number get smaller for materiality purposes, but generally we don't see numbers get larger. The benchmark is kind of the highest level that we'll ever approach. So material misstatement of prior years, high risk of fraud, potential loan covenant violations, all things that might be risky in a client that make us say, I'm a little bit concerned about the operations of this client. I might need to make materiality a bit lower because that means I'm going to have to test more to make more certain. All right. Also, small amounts may cause the entity miss forecasted revenues or earnings or affect the trend in earnings. Okay. So materiality is really, really large, but their income amount is so small that if where there's any, even just a minor adjustment adjustment necessary, a minor misstatement, then they might end up going from an income position to a loss position. Which seems weird, okay? It seems weird, but if we have a situation where a company is actually in a positive amount, they've got positive income, but then we say there's an adjustment, there's a misstatement, and that misstatement is not material, but if we accept that misstatement as being not material, it would put them from being in a loss position to an income positive position. Now, it seems odd. The reason I mentioned that is it might be relevant to your homework. Okay. So looking at seeing what the income is, and if the income amount is really, really small, we're going to be very sensitive to misstatements, even if they are small misstatements, because we don't want companies to misstate their income from going from negative to positive. Also, if the entity operates in a highly volatile business environment, has complex operations, or a highly regulated industry. When we think of qualitative factors, what you should think of are there risk factors that might affect the operations that make us more sensitive as auditors. That's a common theme that we'll see throughout the semester, but it's especially relevant for the concept of materiality. All right, so planning materiality. Our general guideline, our rule of thumb is going to be for public and private, or regardless of whether they're public and private, as long as they are profit-oriented companies, we're going to use 5% of income before taxes, 5% of pre-tax income. That will be the one that we default to in most of our situations. Now, that's our quantitative benchmark. That's where we start. This does not include any qualitative factors like the ones we just talked about. The question here is, when might we use something different? First one is pretty obvious, okay? Let's say that we're auditing a not-for-profit company. Now think about this logically. You're the auditor for a not-for-profit company. Does it make sense to use profit as your benchmark for materiality? By definition, what is this company not designed to generate? Profit. So using profit as the benchmark for materiality is probably not a good idea, which is why we might use revenues or total assets. Another kind of weird one is asset-based entities, like investment groups or mutual funds, okay? So if you ever look at the balance sheet of an asset-based entity, like a mutual fund, investment fund, something like that, they usually have to hold massive, massive amounts of assets to generate a return, like on the scale to hundreds of thousands of their returns. So they've got much, much more assets than they do income. If that's the case, their income may be really small relative to their overall portfolio of assets, meaning that it makes sense to use assets as the basis for materiality rather than income. Those are kind of the common scenarios where we won't use income. Another common scenario where we won't use income is, like I said, when income is negative, okay? We generally don't want to use negative. Also, an interesting one that you might want to make note of is volatile income, okay? So income going from a positive position to a negative position back to a positive position, fluctuating very, very wildly. That's the case, we may be want to be very, very careful about using income as our basis. The reason I mention that is one of the very first things you have to actually make a decision for your homework is, do we want to use pre-tax income to test earthware clothiers materiality? And you're going to have to make a decision based on that. But I'll give you some help on that here in just a second. All right, so that's planning materiality. Like I said, planning materiality is materiality at the financial statement level. All right, that's pretty straightforward. It's pretty obvious. It's going to be some amount that we set up first. So has everybody got that down? Has everybody got that understanding? Because this is the easy part. If you're struggling with the easy part, then when we get to the hard part, then your eyes are going to goggle or something like that, or whatever. Your skin is going to crawl. I don't know. Something weird's going to happen. Okay, so let's talk about talking about how we create materiality at the account level. This is tolerable misstatement. Tolerable misstatement is intended to establish a scope of audit procedures for individual accounts. It can get a little bit gruesome. It does not help that the book does not do a very good job of describing this, and I blame this entirely on the editors. The editors are basically people who came in and tried to update the book and did not fully understand the content. So it can get really, really troublesome if you try to follow what's going on in the book, because the book does not do a good job. The book does a good job of explaining most concepts that we're going to talk about in this course. This is not one of them. So you need to pay close attention to what I'm talking about here, because this is going to be this is the gospel in this course. Actually, it's a gospel for everything in the course, but especially this, because the book does such a poor job. So here's the important things to remember about tolerable statement, where things get a little bit confusing. And the reason I mention this is because the book will be inconsistent with what I'm saying here. So if you're not paying attention to what I'm saying now, and then you say, I'm just going to read in the book what it talks about this, you're going to get a different story. Obviously, I'm going to test on what I'm teaching rather than what the book says. So you need to understand what I'm talking about here. So first of all, auditors generally set a maximum tolerable misstatement for a single account between 50 and 75% of planning materiality. All right. Now, this is really confusing, and this is where it gets really confusing if you're reading the book, okay? Somebody who did the book editing said, all right, that means all accounts should be set between the range of 50 to 75%, which is hogwash, okay? Hogwash, if you think about it, there's a reason why that's the case. Some accounts are astronomically large, and some accounts are very, very small. And planning materiality is a very specific number. If you try to set that scheme for every single account, it may be way too large for some accounts and way too small for other accounts. So what we're going to do is we're going to say, let's set a percentage, okay? And that's a stable percentage. Let's say I'm going to use 50%. That means the maximum amount of tolerable misstatement I can send for any one account is 50% of planning materiality. So if my materiality is $1 million, the maximum I can set for one account is $500,000. So everybody follow that? Planning materiality, $1 million. The maximum I can assign to any one account is going to be $500,000. That does not mean that every single account is going to be $500,000 for tolerable misstatement. If I've got an intangibles account that's got $200 in it, setting that at $500,000 is ridiculous. Okay. There can be numbers far, far lower for a tolerable misstatement in an individual account than 500,000, but the most I can put in any one account is $500,000. So that's why the word maximum is so important. I probably should italicize that and bold it and circle it, but I'm circling it visually or audibly here for you all, tell you that's the case. So that's the first thing, all right? We're going to actually establish a percentage, and we're going to stick with that percentage for our maximum tolerable misstatement for one account. Second thing, firms generally cap the size of aggregate tolerable misstatement for all accounts to 3 or 4 times planning materiality. Now, we need to define what this all means. If I take every single one of my tolerable misstatement amounts together, so I'm going to assign a tolerable misstatement for cash, a tolerable misstatement for accounts receivable, a tolerable misstatement for investments, tolerable misstatement for PP&E. I'm going to go all the way down my balance sheet and add all these things together, and that's going to be my aggregate tolerable misstatement, all of those numbers added together. When I'm done, that number that I've signed off for all of my tolerable misstatements for all of my accounts should be somewhere in the range of 3 to 4 times tolerable misstatement, and you'll be given a specific threshold. For the book or for the assignment that you're doing on Wednesday, it's 4 times planning material, or so 4 times planning materiality. Basically, what that means is when you add all those numbers together, it should be right at 4 times planning materiality, but not over that. You should try to get as close to 4 as you can. It's like Price is Right, as close as you can without going over. Okay. Now, there's a lot to unpack here. It doesn't make a lot of sense. The first one is, why are we doing a number 4 times larger than planning materiality? Shouldn't it be all those aggregates should be less than planning material in total? And I like what you're thinking. I like your thought there, okay? Because you're thinking if every single account is misstated, then we're going to be still below planning materiality. But think about this, what I just said. Every single account is misstated. If you're an auditor, do you expect every single account to be misstated? If it is, you're in a lot of trouble as an auditor, okay? You can be like, oh my gosh, I've picked the wrong client, okay? Even though we set a maximum amount of tolerable misstatement for every single account, our hope is as auditors that most of these accounts are correct. Or if they're misstated by very small amounts. So setting a maximum tolerable misstatement for an account is basically kind of a worst case scenario, okay? Worst case scenario where we could accept it, but it's still okay. We do not expect all of our accounts to be misstated by that amount, which is why we can actually set this at 4 times planning materiality, or maybe lower, 3 times planning materiality, or 3.5, whatever that might be, okay? So that's the first thing to keep in mind, all right? Second thing to keep in mind is when we're talking about materiality, that's going to be a static amount as well. So you're going to establish what it is. You're going to say 3 times planning materiality, 4 times planning materiality, and you're going to add those numbers together. So a lot of people, when they do this first assignment, because you're going to have to do this for the assignment, say, well, Dr. Barnes, I can make a number that's far lower than 4 times materiality. 4 times planning materiality. So they add all their planning materiality amounts together and they say, well, look, I got 2 times planning materiality. That's much lower than 4, and I'm being efficient, right? What does it mean when our materiality is small, when we set tolerable misstatement amounts as small? It means that we can only have small errors and still be okay with it, okay? So you decide to set your total aggregate tolerable misstatement at 2 times planning materiality. The auditors come in and they say, I hate you, okay? Because you're going to make me do a lot more work. So we want to get as close to that 4 as possible because that means less work in aggregate because we are trying to make as big a gaps as possible. Now, obviously, setting it above 4 is as a non-starter because then we're saying, okay, there's a likelihood it could be very material if we see errors and we would not detect them. So we're trying to find the exact point where we say we have to do the minimal amount of work subject to the constraint of making sure that everything is not materially misstated. That is why we say get as close to 4 as you can without going over, or get as close to 3 as you can without going over. All right. So let's go ahead. I'm going to show you really quick. I'm going to give you an example of the assignment. I forgot to open this up, but I want to show you what the materiality work papers look like and kind of give you a guideline of what you're going to be looking for. So basically, you're going to have some instructions in here. By the way, you'll want to refer to the materiality guidelines that are also on Brightspace. It's really important. They're called the Willis-Adams Materiality Guidelines. They will give you invaluable information about the approach that you need to take. Because if you don't read through those, then you'll be guessing, and you don't want to guess on this. You want to make sure that you know exactly what criteria you're going to be utilizing. So the first thing is we're going to do planning materiality. We're going to do our planning materiality. So we're going to say, all right, what's our measurement base? Now, what did I say our measurement base was in most situations? Pre-tax income. Okay, Earthware Clothiers, you've already done some research on them. Are they a profit-oriented company? Yes, based on the research that you've already done, you know they're a profit-oriented company, okay? So pre-tax income, and what did I say my guideline, or the guideline was here, the percentage? 5%, okay? So that's our default, that's our default. Now, does that mean that we're gonna accept that at face value, or we're just gonna basically say, all right, this is good, these are both good? They possibly could be, okay? This could possibly be a fine number, and I could not make any adjustments here. But you're gonna have to scrutinize both. You're gonna have to scrutinize, is pre-tax income appropriate? Is 5% appropriate? All right. If you don't use these two, then you have to actually justify any adjustments. Like if you make an adjustment pre-tax income and use a different base, you have to justify why. There are some reasons you may want to consider a different one. There's a lot of reasons why you'd want to consider using this one. Okay. If you're going to make an adjustment to percentage, you have to justify why. You actually have to justify them both down here. Okay. In these yellow boxes. But for sake of time, let's just go ahead and assume that these are both okay. All right. So then we're going to go over to our second work paper, and you will notice there are a lot of accounts. Some of these are already filled in, some of them are not. And you'll notice that when I add all these together here, they add up to a total of 5,800 of tolerable 5,800 tolerable misstatements in aggregate, which is 1.7 times planning materiality. What did I say that we wanted to get close to? 4. For this particular exercise, we're trying to get close to 4. Which means that we still have some numbers to fill in. That is your assignment, is you're going to have to go in and try to fill in what these numbers are, which I realize. So first of all, let me say this, okay? I've taught this for 10 years now. I don't think that I've probably got the same answers, unless somebody had a solution manual beforehand. I don't think I've gotten the same answers from any student ever, okay? Simply because there are a lot of different ways you can interpret this. Secondly, you're going to go in this and say, I feel like you have no idea what you're doing. You're going to be feeling the common theme from all of the students who have ever done this before, okay? Do not feel daunted by this saying, I'm not sure what I'm doing. That's part of the activity, is trying to figure this out. There are some clues that kind of give you some tips here. Like you can notice inventory is given. It says the large complex accounts with misstatement expected. If you think that's true for other accounts, you can use that as kind of your explanation of why that's the case. But you have to actually set tolerable misstatement, and you have to set an explanation. Now, remember a few criteria, okay? A few criteria to note. When you're going through and setting these amounts, you don't really need to worry about this account balance percentage. That's a reference. But you do need to be very cognizant of planning materiality percentage. Because according to the guidelines that I assigned you to read, there's a certain threshold that you cannot exceed, which, by the way, is 75%, okay? Every single one of your accounts cannot have tolerable misstatement in excess of 75%. So you're going to go through here and try to assign as effectively as you can numbers that are going to be high, but not so high that they exceed 75%. And then also, while you're going through this, what number are you trying to make this equal to? 4. You want to make that as close to 4 as you can without going over, because that means the least amount of work for the auditors, but still making sure the materiality is correct. Now, I'm going to give you a couple of tips, the way to think about things, okay? There's a few ways to think about these. When we talk about how we actually think about tolerable misstatement, let me go ahead and show my slide. Okay. The lower tolerable misstatement is, the more extensive the required audit testing is. So auditors have to strategically assign tolerable misstatements to individual accounts while still retaining planning materiality. Now, this is a really confusing concept. So I use an analogy, which of course I'm a food analogy because I'm me, okay? So think about planning family dinner. Does anybody have family dinners like with like Thanksgiving meals with their families? Okay. So I get together with my family and I still think of my nieces as when they're kids. That one of them's is 15, another one just turned 12. So they're not really kids anymore, but I still remember the Thanksgiving dinners when they were like 6 and 3. Okay. So you got me for Thanksgiving and I like a good Thanksgiving meal. I'll probably have a full plate, then get leftovers. Okay. Or get extras. Okay. How I'll go for seconds. All right. Then you get my sister-in-law. My sister-in-law is about a third my size and eats twice as much as I do. Okay. I don't understand how it happens. Metabolism works wonders in their family. It's weird. It's weird. My brother is completely different from me. He's a long time smoker. He doesn't smoke anymore. Long time smoker. Never had much of an appetite. So he'll eat like half of a plate of food. My mom, she like eats like 3 bites. And it's like, I'm so full. That was so good. Okay. She's an 83-year-old lady. She barely can eat anything anymore. And my nieces, both of them, have infinite energy, and I don't know where it comes from because I've never seen them consume food in my life. Okay. That's actually not true. You take them to Chick-fil-A, they will actually go nuts. Okay. They'll go ham on Chick-fil-A, but give them Thanksgiving dinner, they'll just be kind of like, I don't want to. That looks gross. It's like, it's turkey, it's potatoes. Come on. Yeah. So if you plan on any one of those individuals, if you basically, let's take the amount that Michael eats and multiply that times 6, you're going to have way too much food. If you take the amount that my nieces eat, you'll have 0 food. Okay. So you've got to actually account for every single one of the individuals at the table and try to plan on that. Now, we always have plenty of leftovers, which I love because I love Thanksgiving leftovers. But you get the idea there, is that trying to think about every individual and not just one individual and multiply it as an aggregate. Same holds true here, is that we have to think about every single account individually. What are we going to consider when we're considering the amounts? The answers are going to be size, activity, complexity, and risk. Now, if it's a large account, an active account, or a complex account, that generally will drive tolerable misstatement up because we want to give us ourselves as much room as possible to be wrong and still, or to have it in misstatement and still not be material. The one that throws a little bit of a loop in here is risk. If we think account is a risky account, and usually this is based on previous activities or previous misstatements, that's when we'll try to make misstatements smaller or the tolerable misstatement smaller so we can detect smaller misstatements. I generally try to opt for the first 3 and I focus more on the first 3 and then I focus the risk on the very end. Okay. Simply because I would like the accounts to be as large as possible if I'm an auditor because I want to do as minimal amount of work. I'm utility maximizing, which means I'm work diverting. Okay. If I can make my colleagues do more of the work, unless it's responsibility. We talked about that earlier, shuffling off responsibility. I'll still do my share of the work, but if I can get away with all the work and so my colleagues don't have to do the work, nobody has to do any extra work, that's great. Okay. Everybody wins. Everybody wins. So let's go back to that spreadsheet. So I just want to think about a couple of accounts here, a couple of accounts that might be relevant. Now, cash I'm going to leave alone for right now. I will tell you right now, one of your things you should note about cash is extremely easy to audit. Okay. You might want to make a note of that because that might be relevant to your decision. Now, why is cash really easy to audit? Think about it. If I were to ask how much cash do you have as an individual, could you answer that question for me pretty easily? Yeah, you could open your wallet and then you could get on your phone and get your bank account and then you could actually log sources and identify that really quickly. It's very easy to calculate. That's why it's easy to audit. What about receivables here? Okay, let's think about receivables. Now, what is the nature of this organization that we're talking about here? Are they a business to business organization? No, they're business to customers. So they don't have a lot of receivables. It's only about like 8.7 million. It's a fairly small account. So the size is pretty small relative to the whole. What does that mean about tolerable misstatement for this particular account? It's probably not going to be very large. It's probably not going to be nearly as large as another account like inventory, which is massive. Okay. So you can kind of use this as a guideline. Receivables is not an active account. It's not a heavily active account because they don't do a lot of credit extension to customers. Most of their customers pay when they actually purchase from the organization because they're a retailer. So that's something to consider. What about, let's go down to, what's another one? Accounts payable. Accounts payable. Here's another one. Accounts payable is just the flip side. Do you think accounts payable is a heavily active account? Well, it's 60 million. It's not as active as inventory, but it's much larger than receivables. So I'd be a lot more concerned about accounts payable than I would be receivables here. So that's what we're going to say. It's a large account. It's probably got a lot more activity, not a lot of complexity, but still more complex than something like cash. That's going to be guiding what you're going to be assessments. Now, again, There's no right answer to this. This is all heavily subjective. I will give you the solutions that the publisher has. I will guarantee that unless you cheat, you will not get every single one of these the same as the publisher. And that's fine, okay? I will tell you, if I went out and audited a company and then assigned these numbers and then audited the exact same company like a year later, exact same numbers, exact same activity, I would have completely different assessments, okay? It's never going to be one of those things where it's always a right answer. This is going to be subjective and justifying your decisions that you make. Everybody on board for that? Yes. Sure. So basically what happens is that we have a established planning materiality, okay? This is the statement, or this is the amount that we can accept that the financial statements as a whole are misstated by. Okay, so in this case, it says it was 3.5 million. That's what we determined over here. When we add together all of our tolerable misstatements, and this is not complete because we've got several of these that are blank right now, this number right here that's currently 5,800, which will become a larger number, should be as close to 4 times this amount right here as we can get. The idea being behind that is that we want to have as much room as possible for tolerable misstatement in every single account. And so we use 4 as our threshold. Now, again, if every single account was completely misstated by the maximum amount, we'd be well over our planning materiality. But we do not expect every single account to be misstated as auditors. Okay, if every single account is misstated, we'd be like, what the heck have you guys been doing here? So that's why we can set something as broad as 4 as our threshold for planning materiality and still be pretty comfortable that we're going to come in under planning materiality.
But it's a good thing that they're both one, that their accounts aren't as misstated as.
Well, so it wouldn't. What we're going to talk about the decision here in just a second, but what our goal is that when we look at all of the actual misstatements, the results of our testing, we do need to be below that planning materiality. The 4 is just an assessment of tolerable misstatements, the maximum amount that each individual account can be misstated, and then adding all those numbers together. Okay, it's a good question. It is very confusing. All right, so let's go ahead and let's jump to the end of the audit. Now, I know we haven't done anything in the middle, so it's going to be a little confusing, but we do testing for the audit. We're going to actually test these accounts and we're going to establish, is this account correctly stated? If it's not correctly stated, by how much is it off? Differences from what the account statement is on the trial balance and what we as auditors believe it should be, those are called misstatements. Okay, and when I say an actual misstatement, that is something that occurs as the result of testing. Now, keep in mind, we're going to find out a little bit later on that an actual misstatement is a bit of a misnomer because we could believe something is misstated by a certain amount, but it's not an objective amount. It's something that we believe based on certain criteria. Say, for example, bad debt expense, the client only assigns 1% in the past, and we believe it should be 1.2%. That difference of 0.2% could represent a misstatement. That does not mean that the financial statements are actually misstated by 2%, 0.2%. It means that the financial statements, we believe them to be misstated by that. But for all intents and purposes, an actual misstatement is something that occurs as the result of testing in the auditor work. So we look at all these misstatements and we're going to actually determine what's going on. So based on the results of audit procedures conducted, the auditor aggregates misstatements for each account disclosures, okay? And it's important to note that during the testing, if the auditor wants to revise their assessments of planning materiality on a tolerable misstatement, they can do so. So say, for example, you're looking at risk and you're like saying, I think that I made planning materiality too large, or I think I made a tolerable misstatement for this account too small. Those are adjustments that you can make over the course of the audit if you have good justification to do so. But what is it that we're ultimately trying to make a determination? So when the auditor is evidence gathered, we're going to aggregate misstatements from each account, okay? And we're going to take those actual misstatements, actual in quotation marks, those actual misstatements and add them together. That's our aggregate misstatement. We're going to compare our aggregate misstatements to planning materiality. So we say the financial statements can be misstated by $1 million and we're fine. We look at all of our misstatements from the result of our testing and it's $800,000. How do you feel about that as an auditor? You're like, that's great. That's great. That's below our tolerable misstatement. We're good. We can go on and hang out on the beach in Tahiti or Hawaii or wherever some tropical paradise is. Okay. So if all of our misstatements are less than what our planning materiality is, then we're in good shape. All right. If the aggregate misstatement is greater than that planning materiality, that's where we have a problem. So we say it's $1 million. We aggregate all of our misstatements. It's $2 million in misstatements. That's where we as auditors say, all right, client, you've got some decisions to make. Your financial statements are misstated. You're going to have to make some adjustments to your financials for us to approve them. Now, there is a small caveat. I don't want to spend too much time on this because we've only got 8 minutes left. What about if the financial statements in aggregate are not materially misstated, but you've got one account that is materially misstated? So say you set tolerable misstatement for the account at $50,000 and it was misstated by 75,000. That is going to be a judgment call on the part of the auditor. In many situations, they will still require the client to make an adjustment, especially if it's an important account. Like Earthware Clothiers is an inventory company. So if they had misstatement, a large misstatement in inventory, even if their financials were not misstated as a whole, we still might make them make adjustment to inventory because it's a critical account for that particular company. That's not a requirement, but that is a judgment call that's usually made on the part of the auditors. If it's an insignificant account that's not really important, then we may just accept that a misstatement greater than tolerable misstatement is fine. All right. But that is kind of the guideline that we operate from. All right. With that, we are materially done. Okay. Materially done. So let's go ahead and let's talk really quick about our discussion. And I say really quick, I do mean really quick because we don't have a whole lot of time. All right, so you had to do some research on Earthware Clothiers, okay? And I wanted you to look at some information. I wanted you to look at their client continuance case file, which is the spreadsheet. I also wanted you to look at the background. And I also wanted you to, if you had access to the book, read through the annual report. Some interesting stuff going on in the annual report, by the way. Yeah, if you read through that, that's a good source of detail. So just for note, it was the annual report from the previous year, 2004, okay? We're getting ready to do the audit for 2005. For obvious reasons, they have not prepared their 2005 annual report yet because they have to have it audited in order to be able to do that. But so we're looking at the 2004 report, we can actually glean some information about the nature of this organization. So when I say EWC, that's Earthware Clothiers. That's the name of our client. Who are we? We're the auditors. We're Willis and Adams. Okay, Willis and Adams is the name of the audit company. They've been auditing for almost 50 years now. In fact, this will be the 50th year anniversary. Yeah. So we're going to try to make a determination if we're going to accept this, continue to accept this for a 50th year. All right, for a 50th year. So there are some questions that I have you answer, and I want you to kind of consider some of this. So are there any business risks the auditor should consider as part of its decision? By the way, the answer to this is yes. The amount of detail that you put into this was your subjective question. Okay, how many business risks? So what are some examples of business risks that we probably should consider in this situation? Yeah, system. So they had a accounting information system glitch, and so they implemented it in 2023, and they had some problems getting it to be accurate. They think they'd fixed it by the end of 2024. So it's been hopefully in place for a full year now, operating properly. All right, but the accounting information system problems from the previous year are definitely a concern, a business risk. What else?
Chief accounting officer left.
Chief accounting officer left. Okay, and they got replaced with somebody who they are not certain that she's actually qualified for the job. Okay, that's a good one. Any others? Highly competitive industry. Good. Yeah. So we're talking about retail industry. Then we list about the competitors. I think this company is based on LL Bean, which I think is funny that they actually gave LL Bean as competitor. I also tend to point out the fact that I think this is a legacy industry. I don't think many companies exist like this anymore that operate via catalogs. Most of them operate via internet connection. They do have an e-commerce profile, which actually is a long time in coming. For like the first few editions I taught of this book, they didn't even have e-commerce. Okay, which keep in mind, I've been teaching in 2015. The internet's not there, is not that young. It did exist back then. So yeah. So some good observations, some good business risks that we can actually identify here. So all things that we can consider part of the decision. This one's a really, really minor one, and this one kind of lets me pick and see how detailed you did your due diligence. Are there any incidents that suggest an issue with management integrity? There's one. Which one is it? The gambling, yeah. So if you looked in the spreadsheet, there's actually a little bit of a note. I didn't have you complete the spreadsheet. But number 4, okay. So Ethan Davis was charged with a misdemeanor, and so had $750 in community service. Okay. So yeah, some management integrity. Now, how do you feel about that management integrity issue? It's like that management integrity about gambling, but he broke the law, but it actually doesn't have anything to relate to business operations. So consideration, yes. Okay. So something that's going to give you a lack of confidence in the nature of the operations organization? Probably not. There may be some things that we have to consider from a fraud perspective, but we're going to get to that next chapter. Okay. Very, very minimal though. Very, very minimal. All right. So then we're left with a question. We're left with a pretty basic question. Should Willis and Adams retain EWC as an audit client for 2025? Well, let's see. Got the C chief accounting officer quitting, and then we've also got the issues with the information systems. I mean, come on, they're not really a business line anymore. They're operating an industry that's been defunct by Amazon.com. And you got a degenerate gambler over there. So, my gosh, it's time to hit the road and just basically say, okay, you guys got to leave somebody else. You guys are ready to say no? I'll give you a hint. We can't say no. This is our company that we're going to be using for the rest of the semester. Okay. No, this is actually an excellent company. This is an excellent company. Everybody, I think you should have answered yes on this one. And if you didn't answer yes, that's okay. This is not for a grade. Okay. But yeah, if you had this minimal amount of incidents and you were going to this as an auditor, you'd just be kind of like, oh my gosh, this is the greatest company ever. I never had a company this clean when I worked in auditing. They're always far more, and this is a much larger company than some of the ones I worked for. And some of it's like, for the first client I went on, they had a massive fraud that they were dealing with. My first year there, they were just dealing with a fraud that they management fraud that they had to resolve. So if we're willing to do the audit for after management fraud on a company, then I think that we can actually say this company that's got like a minor gambling issue and some controls that we had to deal with, that would be fine. We can handle that, especially since we've been on this client for 50 years now. We know what's going on. We have a good basis for understanding. So yes, we're going to continue working on this client. If you answered no, you're going to have to reverse your decision because everything that we're doing forward is going to be using this client. Okay. It's going to be pointless if we don't have that. So yeah, need to make a decision. Quick note, we are done. This question is going to come up. So we are out for next Monday. We're going to come in for chapter 4 to start on Friday. Chapter 4, we're going to conclude on Wednesday. We have an in-class activity that we're going to be doing on Wednesday. It is like a discussion, but there's no advanced preparation. You just need to come in, okay, to class, which I expect you to do anyway. So that's all you have to do. Just show up for class. All right. Have a good day. See you all then.